Everyone, welcome back to my YouTube channel, Manisha Gupta. So I am my name is Manisha Gupta, and on my YouTube channel you will find the content related to the exam kit solving and difficult topic or question solving videos. Or if we talk apart from our technical knowledge, you will also find the video related to the improving your Excels and your basics English. So these are the content that I used to share on my YouTube channel. So if you found my content useful, please don't forget to subscribe. I know I just say multiple of time, but there is no any the effort from your side. So but still okay, please, if you found my video useful, please don't forget to subscribe my channel and share it among your friend. In today's video, we will solve one more long question. This is from the Management Accounting F2 and the question is from the Kaplan kit. Question name is J Company and the question number is 463. So let's start this question today. J Company is considering investing in a new machine costing 18,750 payable immediately. Okay, so they are planning to invest in a new machine and the cost of new machine is 18,750 and they need to pay this immediately. So the scrap value will be zero, means after using this machine for certain years, its scrap value will be zero. Machine will be depreciated on a straight line basis and output would be 1000 unit per year for each of the 6 years of machine lives, each unit on a contribution of 5. See, there are lots of things which has been explained in this paragraph. Like first thing is that Jco is going to purchase machine whose cost is 1875, but this is payable immediately, means in the year zero. Right now you have to pay this amount. And other thing that you need to think about is scrap value, which means as the question mentioned that useful life of the machine is 6 year, means after using the machines for the 6 year, its scrap value will be zero, means you will get nothing if you will sell out this machine after 6 years. And other thing is about the depreciation. The question is saying company used to depreciate on the straight line basis, but this question is related from the investment appraisal. So depreciation is non-cash item, so we won't take these things while doing the calculation. So we just ignore this. If they suppose they are provided the profit figure in which depreciation has been included, in that case we need to add it back. Okay, output will be 1000 per unit, means company Jco is going to earn this output each year and the contribution is 5, means your sorry, your contribution means selling minus all the variable cost. So there is no any fixed cost given in this question, so they have provided simply contribution which is 5, means if we are earning 5 contribution for each of the units, so how much contribution we earn for the 1000 unit which we are producing each year? So obviously it's 5000, right? So first question is asking, assume that cash flow arise evenly throughout the year. What is the payback period in the years and the month? So what does this sentence means? This sentence means that your cash flow is equal. So means if I will talk about the requirement A, so here we having 0, 1, 2, 3, 4, 5 and 6 because useful life of the machine is 6 years. Yeah, okay. And the question is saying that company Jco will earn evenly throughout the year, means as company is producing the output of currently 1000 in each of the year, company is producing 1000. Okay, so I'm just copying paste this information, and contribution will be total contribution. So contribution is 5 per unit. So what will be the total contribution for the 1000 unit? So it's simply we need to multiply, and it's 5000, and yes. So this is what the sentence is saying, that company cash flow is even, means it's equal throughout the year. There is no any changes. So now question is asking the payback period, means as we are investing how much amount, minus 18,750 immediately. So these are the currency, and above 1000 is the number. Okay, so as we are investing 18,750, so question is asking in how many years and the month you will get back your money. So they are simply asking the payback period. So year 0, and the cash flow will be your cash flow will be minus 8750, right? So now in the year 1, how much cash you have generated? It's 5000, right? So how much money is remaining? So as you recover 5000 out of 18750, so how much money is still remaining? It's 13750. Similarly, in the year 2, again you have earned 5000, and then again how much money is still remaining after adjusting this amount? Still 8750 is remaining to be earned. So for year 3 again we have earned 5000, and so how much money again we are left to be earned? It's 3750, I mean left to be recovered, I mean to say. And in the year 4 we again earned 5000, so how much money is still remaining? No, here you can see we are getting the our, I mean excess money above 18,750. So till date we are just earning and netting of our value, I mean which we have initially invested. So now from the year 4 you can see there is the positive balance. So that means 3 out of 5,000, 37,050 belongs to the machine parts, right? And the remaining is the extra amount that we earned above 18,750. Means we are getting back our money which we have initially invested in 3 years and few months. And so we got our answer for the years, but month we are still unsure, right? I hope you are getting what I'm trying to say. Basically, payback period means in how many year you will get back the money which you have invested. So we have invested 18,750. So we have to find out in how many years we will get back this money. So as you can see, from the 4th year there is positive balance, that access balance we are recovering above 18,750, right? So we are pretty much sure that the year it take will be 3, but how many month we still need to confirm. And how can we get the month? You need to take this 750 which is still remaining to be recovered, and then the what you have earned in that period. We have earned 5000, and then we will multiply this by 12. So that means 3 years 9 month, in the 3 years and 9 months we can get back our money 18,750. Or what you can do is, there is other way as well. So you can simply take 18,750 and divide by the 5000, because the cash flow we earned is the even. So we got 3.75. So simply 3 is the fixed, 3 is the 3 years, and 0.75 you simply multiply with the 12, you will get your value, that's a 9. So 3 years 9 month is the payback period for the machine we have invested, right? I hope you are clear, right, up to here. So now next question is, the management of JCO have heard about the concept of time value of money required. Complete the gaps in the following statement. The time value of money means that $1 now is worth more than, less than, the same as $1 in the future. The reason for these are risk, deflation, inflation, and potential for the earning a return. Example, interest. See, according to time value of money, if you will get the good example is the gold. If you remember, if you look at the few years back, the gold price is around, it's certainly hike within these few years, right? So this is a time value of money. That means the rupees that we are holding right now will be, its value will be more in the future, and the reason is the inflation. Due to inflation, the price of the goods also rises. So the goods which were costing 10 few years back, it's now costing 20, 25. It's due to the inflation and time value of money. So what would be the our option? The time value of money means that $1 now is worth more than $1 in the future. So you have to choose more than, and the reason for this are the inflation and potential for the earning a return. Example, interest. Okay, next part. Using the discount rate of 8%, assume that cash flow rise at the end of the year. What is the discounted payback period? See, the payback period here we calculated in the part A, and this two is almost same. The only things difference is that the part A that we calculated is the simple payback, where we don't have incorporated the time value of money. But in the part B and 2, we have to incorporate time value of money. That means we have to discount those cash flow to the present value. Let's do this together. You can see I have just done here. So this one is our year. So year is your 0, 1, 2, and 3, 4, 5, right? And I mean up to 6, because the useful life of the machine is 6. That's why I have taken up to 6. And the cash flow immediately is the 18,750, and then we will earn 5,000 constantly. But we have to now discount this cash flow. And how can we do that? By using the discount factor. You don't need to remember this all these things. So you will be provided with those discounted table sheet in the exam, so don't need to worry about that. And again, if suppose like if you are appearing for the FM, there again this thing will be will meet you in that subject. So you can calculate the discounted factor using the Excel tool as well. So I have done the same. So this is the one I simply, and then for discounted factor for the 1 year at the rate of 8% will be, I have taken the 1 and then divided by 108%, and squaring to the number of year. So what I mean to say, you can take the value 1, then divide by 1 plus 8% is a discount rate that question have mentioned to take, and then you can take power to the number of years. So again here for 2, I have taken the 1 divided by 1 plus 8%, power to the number of years is 2, so I have power 2. And here for 3 and 4, so on. So this is the discount factor, or you can take this discount from the table. So you just need to go to the year 1 and take the 8% discount factor rate. Okay. Now I have multiplied this, so now this is the discounted cash flow. Okay, so you can see here this is the discounted cash flow. Now question is asking in what time you will get back your money. Okay, so again we will follow the above approach. So in the year 0 we have invested 18,750. Now in year 1 we have received this much amount. So how much amount is still remaining to be received? So it will be 14,120. And for 2 again we have earned this much amount, and how much still we are left to be recovered to our initial investment? it will be this plus this. Okay, now for again we will go towards the year 3, and here it is. So this plus this. All right, so again we are in the negative. Whenever we got the positive value, we will stop here for the calculation of the year and the month. So here, okay, so it's again negative, so we will look toward the year 5. So this plus this. All right, so yes, we got our positive value. So that means in the 4 year and the few month we will get back our money. So we need to find the month now. So here again we will go toward this and divide by this figure how much we have received and multiply this with the 12. Okay, so that means 4 years and 7 months we will get back our money. Okay, so this is by using the discounted payback method. Okay. All right, so next, using the discount factor 8%, what is the net present value of purchasing the new machine to the nearest dollar? Okay, so question asks you to calculate the NPV, net present value, and we are done with that as well. So here it's simply add this all figure. Yes, these all are the discounted cash flow for 6 years, and how much we are getting? It's 4.3. Just let me show you by doing the sum. So here NPV equal to sum. Just take all this value. Okay, and close the bracket. Yeah, it's 4364, and the question is asking the nearest, so don't put the decimal number, simply keep 4364 and you will get the full marks. So don't keep the answer in the decimal place, otherwise you won't get the credit. It's quite easy, right? Okay, so last question, are the following statement about investment appraisal true or false? All right, statement 1, if the cost of capital increased to 10%, the net present value of the purchase of new machine would decrease. See, it's the, I mean, it's correct, but I can prove this thing by example. Suppose if we will take 10% instead of 10%, I mean 8, we will take 10% instead of 8%. So please remember this value. In at 8% we are getting NPV of 4364. Now let's calculate for the 10%. So how much we will score? Yeah, it's now 3026, right? So NPV has been declined when the cost of capital is increasing. So that means statement 1 is correct. Okay. Statement 2, the payback method of the investment appraisal is a useful method to consider the time risks. Basically, actually this is the foundation of the our time value of money, right? So that we need to consider the we need to consider that inflation in our cash flow that we are receiving in the future. But in the payback method, if it is simple payback method, in that case we don't consider the time value of money. So your time risk means uncertainty over how long it takes to recover the investment. Obviously it's not fixed. And payback method focuses on how quickly a project recovers its cost, so it ignores the any additional cost that we have earned above our initial investment. That means ignore the cash flow after the payback, but it does so how long the money is at risk. And so in that sense, yes, payback does reflect time related risks, even though it does not factor in the time value of money. So it's also correct. So we are done with this question. In the next video we will do this question, so stay tuned with my video, and thank you so much for watching. Have a good day.